mathematics. This is going to be a very useful knowledge for all of us, whether we are accountant or entrepreneur, and it's going to go a long way because all of us, one way or the other, we find ourselves using financial services. And the things of this world, if well approached, they are not complicated. So we are not going to complicate simple interest, compound interest, annuity, and sinking fund. We are going to pick them one after the other and measure them. Basically, interest will be simple or compounded, and for exam purposes they are going to let you know whether it's simple or compounded. And whether you are an investor and entrepreneur too, the bankers, financial services will let you know whether the amount of the service you are taking is compounded or on a simple interest. So at the end of this series, we are going to be able to differentiate between a simple interest and what a compound interest is. Also, you will be able by yourself to determine the final value of the amount that you've invested at a given rate of a simple interest. So whether you are investing or you are borrowing, this knowledge is basically useful because there is no three-way to it. It's either you are a lender or you are a borrower. So either way is good, and the knowledge will be made available for us. Also, at the end of the day, we'll be able to calculate the final value of an amount invested at a given compounded interest. Don't forget, we made mention of simple interest. Now, if it's compounded too, you should be able to calculate it at the end of the day if you follow us through. Also, we'll be able to calculate rates of interest for non-annual periods, given the annual rates. We are not going to complicate it. Then we'll solve annuity and sinking fund. But we are not going to start with that. Just as we said, things of this world are not complicated if we approach them the right way. So when we are talking about interest, what is interest? We can talk about interest and define it as an extra amount an investor receives after investing his money, treasures in a particular time at a particular rate. So the certainty of the rate is important, and the certainty and or duration of period is important. We can equally say interest is additional amount of money paid by the borrower to the lender for the use of his money in form of loan and the like. So that is what we can basically call interest. It's not complicated. It's as simple as that. Like I said when we begin, it's either the interest is compounded or the interest is a simple one. So let's pick it after the other, and we are going to calculate it. I will be showing it on the board, and so that we can understand. So we start by a simple interest rate analogy. When we are talking about a simple interest, it simply means if the rate is, let's say, for example, 10%, 10% is ICA, right? Is 10%, and you've agreed maybe with the banker or with the family member that is giving out the money that, okay, 10% I will be paying per annum on the amount, and the person said, see, only 3 years I'm going to release this money for you to use for 3 years, and you will be giving me my interest on it every year on a simple basis. So it simply means at the starting point, let's say you take or I take, let's use me as an example. I take 10,000 naira from you at a simple interest rate. 10% of 10,000 simply means 1,000. So it simply means every year I will be paying 1,000. So at the end of the 3 years, I will pay 3,000 extra over the 10,000. Then another thing we will have agreed on is whether to pay the interest in lump sum, that is paying it together at the beginning of the borrowing time, or I will pay it at year 3. I hope we understand. So depending on the agreement, you can say, okay, you pay me 3,000 now, and my balance you pay at year 3, the principal. Or as you are paying the principal, you are returning the interest. So depending on what we agree on, basically that is simple interest. It's not more than that. And by the time we are using formula, R simply means interest. R simply means interest rate. Why 1 is usually constant. That is 100%. Any money you borrow is at 100%. That 10,000 is 100% 10,000. So it's always constant. The principal is always constant. The amount is definite. So 1 is always constant. Then the principal you borrow, which is 10,000, is constant too. So there must be certainty when we're talking about the mathematics of so it's always constant. The principal is always constant. The amount is definite. So 1 is always constant. Then the principal you borrow, which is 10,000, is constant too. So there must be certainty when we're talking about the mathematics. 10% of 10,000 simply means 1,000. So it simply means every year I will be paying 1,000. So at the end of the 3 years, I will pay 3,000 extra over the 10,000. Then another thing we will have agreed on is whether to pay the interest in lump sum, that is paying it together at the beginning of the 10% is right. Is 10%, and you've agreed maybe with the banker or with the family member that is giving out the money that okay, 10% I will be paying per annum on the amount, and the person said, see, only 3 years I'm going to release this money for you to use for 3 years, and you will be giving me my interest on it every year on a simple basis. So it simply means at the starting point, let's say you take or I take, let's use me as an example. I take 10,000 naira from you at a simple interest rate. 10% of 10,000 simply means 1,000. So it simply means every year I will be paying 1,000. So at the end of the 3 years, I will pay 3,000 extra over the 10,000. Then another thing we will have agreed on is whether to pay the interest in lump sum, that is paying it together at the beginning of the borrowing time, or I will pay it at year 3. I hope we understand. So depending on the agreement, you can say, okay, you pay me 3,000 now, and my balance you pay at year 3, the principal. Or as you are paying the principal, you are returning the interest. So depending on what we agree on, basically that is simple interest. It's not more than that. And by the time we are using formula, R simply means interest. R simply means interest rate. Why one is usually constant. That is 100%. Any money you borrow is at 100%. That 10,000 is 100% 10,000. So it's always constant. The principal is always constant. The amount is definite. So one is always constant. Then the principal you borrow, which is 10,000, is constant too. So there must be certainty when we're talking about the mathematics of